Presentation here. All right, so who is Daniels Egg Services? Daniels Egg Services is founded by Andy Daniels, who is a renowned grain trader. He's actually been involved in the grain markets for over 30 years. Got his start for the first 5 as a grain merchandiser. Took the knowledge he gained from that and brought it over to the futures side as a broker and trader. Has been doing that for quite some time now. Well known throughout the grain floors in Chicago as well as the world. Has businesses down in South America and land down in South America, so well versed in the ag markets. In our opinion, a lot of people like to hear what he has to say. And so what is our goal here at Daniels Ag Services, and what do we do? Well, we help participants in the ag world run better operations through the futures and options market. So that's what we do here at Daniels Ag Services. So with that said, let's jump in here, tell you a little bit about myself. My name is Drew Wilkins. That's my picture over there to the right. I think that was taken in April, a few Aprils back after a long, cold, snowy Chicago winter. So I think my complexion there kind of matches my shirt. So it's neither here nor there, though. Just wanted a little icebreaker there for get us going here. So I'm a senior ag market consultant with Daniels Ag Services. I'm also a senior broker with Daniels Trading, publisher of the Wilkins Ag Wire, and a contributing editor at Grain Analyst. And we'll get into Grain Analyst a little towards the end of the webinar, tell you a little bit about it. There's my contact information there at the bottom. That will be displayed at the end of the webinar, so if you want to write that down, don't feel like you got to rush for a pen right now, as we'll have plenty of time to go over that. So one thing before we kind of jump into the meat and potatoes of the webinar here, if you have any questions, feel free to ask them throughout the webinar. I will not answer them until the end. So when we get to the end of the webinar, I will answer all questions. So I'm not ignoring you. I'm just waiting till the end. That way we can go with the flow of the webinar and then jump into the questions there at the end. So all right, with that said, whenever we do something here at Daniels Ag Services, we always like for folks to have a takeaway, whether it's working with clients or presenting things online. So went ahead and told you about Daniels Ag Services. Well, we wear 2 hats here at the Daniels brand. We've also got Daniels Trading, which is the other hat you see there to your right. And on the Daniels Ag Services side, most of what we do is we work with participants in the ag world that are looking to hedge. So whether that be a farmer, whether it's an elevator or a corporation that's looking to offset risk, we help them do that at Daniels Ag Services. Whereas the Daniels Trading aspect comes in, is their people that we deal with are looking to assume that risk that the hedgers are looking to offset. They're looking to trade with hopes of generating a profit. So that's what we do at Daniels Trading. And no matter which branch of Daniels you work with, whether it's the ag services or trading, we like the takeaway to be, and we hope that your takeaway is that Daniels helps me trade and market better because they know ags and give me the flexibility to choose the markets however I choose. Okay, with that said, let's jump right in. We're going to go over corn first, then we're going to go to soybeans, then we'll get to a summary and tie it all together, go over some ideas on how you can take advantage or potential plays you could have in the market based on what we're going to cover here today. So what are we going to cover for corn? We're going to talk about where we've been. We're going to talk about ethanol. We're going to go over exports, domestic usage, and we're also going to touch on production as well. So let's jump right into it and take a look at where we've been here in the corn market. Now we're taking a look at a continuous chart here in the corn market. The reason I wanted to take a look at this continuous chart is over, if you look at the right side of the chart, right here where I just circled, I took that screenshot after the markets closed today. So you can see 427, the black, is where we last traded at electronically. This is a continuous corn chart, and it's still basing it on December. December expires tomorrow, so it'll roll over to March. The continuous chart will after tomorrow. But it's a continuous chart, so it combines all the front months together, and that's how you get a continuous chart for those of you that aren't aware. So today, 427, last trade electronically on the chart when I took this screenshot. When was the last time we were at levels where we currently are? Well, we have to go all the way back to the third quarter of 2010. So obviously we had a lot happen in between here. We had ups, we had downs, we had ups, and then we had downs. So what happened in between those years? Well, we had 3 drought years in a row, and that definitely helped out with the ups quite a bit. Um, 3 drought years in a row obviously is going to put a strain on supply. You're not producing as much, and therefore you've got to incentivize producers to produce more supply. Well, obviously there's been some genetic advancements to help reinvigorate supply, but also you got to make for higher prices in order to have farmers go out there, actually plant and raise the stuff and take it to the market. You've got to incentivize them to do that, and the only way to do that is through higher prices. So we really sent prices higher. As you can see, in 2012, we almost hit the 850 mark. Just missed it. So we almost hit 850 corn. So that definitely throw some incentive out there to plant more corn, and as you can see here with the drop-off, it sure did. 2013, replenished stocks, lower prices. So as you can see, that's why we're back at this 427 area. We haven't been back since the 2010 marketing year. So with that said, that's kind of what happened between now and then. 3 drought years, we replenished supplies this year, and so now let's take a look at what is going to affect the market in 2014. Let's get all these drawings out of here. All right. Now, one of the main things that's been in the news lately, even today as a matter of fact, it's like they knew we were going to have this webinar and they decided to announce some news, is ethanol. As you can see, this chart we've got here shows the the E10 blend wall and ethanol use needed to comply with the conventional reviewable fuels standard and the mandate. As you can see, we're running, the red line is the 10% of U.S. motor gasoline, that's the use, which is the blend wall. You can see we're running into that. And the EPA has taken note, and they have proposed an ethanol cut of 1.4 billion gallons for corn-based ethanol. So it's gone from 14.4 billion gallons to 13 billion gallons, which is a 1.4 billion drop. So what's leading them to come up with this proposal? Well, as you can see, we have more efficient cars. In 2008, the U.S. fuel usage came in at 145 billion gallons. It's expected to come in at 132 billion gallons for 2013. So why is that? We've got less fuel-efficient cars coming off the road, and you've got more fuel-efficient cars being produced every day and coming onto the road. So essentially, there's less need for fuel that is not just limited to ethanol. That's crude oil for that's produced into RBOB gasoline, which are 2 futures markets you can trade as well here at Daniels Ag Services. But it's you need less and less. Obviously, it doesn't make sense to follow the current mandate. That's why they proposed a new one. So also today there was a bill proposed that could completely get rid of the renewable fuel standard mandate and just kind of let market forces play out themselves. And the bill was introduced by both parties, Republican and Democrat, with 10 senators backing it. So it'll be interesting to see how that plays out. Farm lobby's pretty strong. Don't see that really coming into effect, but it's just showing that adding fuel to the fire to the EPA's proposed cut that makes it a little more likely that we could see that now, as it's just a proposal. Probably won't happen until the spring, but it's interesting to note that that's coming out. And another thing I want to touch on with ethanol is you can actually produce a gallon of ethanol from natural gas for 70 cents. For corn, it takes $2.50 to produce a gallon of ethanol. So that's something to keep your eye on too. If the United States ever decides to really tap into the natural gas reserves we've got, it's a whole nother kind of conservation scenario altogether too, with the things about fracking going on. So who knows if we'll ever tap into that? But if we do and start using that, that's another thing that could take away from corn-based ethanol demand. So the 2014 impact we believe that ethanol has is we believe that there will be less demand in the corn market for ethanol-based corn based on this cut. This is a proposal that we believe will probably go through, and we'll need 1.4 billion gallons less of corn-based ethanol. So with that said, let's take a look at the export markets, the next thing we're going to cover. And real quick, I want you to focus on the blue. The blue is the United States, the red is Argentina, the green is Brazil, and the purple is Ukraine and then the yellow-orange there is the rest of the world. So take a look at the blue and look at it from left to right. And it doesn't take you long to figure out that that's a pretty clear downtrend. Starting in, especially in the 2010-2011 marketing year, we really started going down. And of course, you look at the 3 years from 2010 all the way to the 2012-13 marketing year. Obviously, we had 3 drought years in a row. That's therefore going to have less corn to export when you're growing less. But one of the main things that's really kind of amped up and taken away from our exports is the fact that Argentina, Brazil, and Ukraine have really started to learn how to grow crops more efficiently and move them throughout the world more efficiently. So if you take back and look at 5 years ago, Argentina, Brazil, and Ukraine represented 25% of total exports. For the 2012-2013 marketing year, they represented 65% of total exports. That's a pretty big increase. So I mean, that's a 40% increase. So it's nothing to sneeze at. And obviously, they're getting bigger and bigger and bigger. I mean, just look at their colors. Look at the red. Look at the green. And look at the purple. Very easy to see that they're exporting more and more and more. And the United States has lost our export dominance. Higher prices taught the world how to produce corn more efficiently and at a greater level. They're using land that they had never used before, therefore they're producing more corn. So what do we see as far as 2014 impact? We think that we'll continue to see continued competition. And obviously we've got more corn to export now, and we're at more competitive prices, but that's what it's going to take. We're going to have to be at the competitive prices we are now in order to continue to compete with these countries as far as exports. Otherwise, we'll continue to see a slide. So now let's jump into domestic feed demand. And just to give you an idea on what these colors on this chart are, the orange is feed and residual, the yellow is ethanol, and then the blue is other feed, seed, and industrial. So our opinion on domestic feed demand is we're kind of at a generational peak as far as feed demand goes. And as the population is getting older, requiring less caloric intake, then of course prices have rationed demand here recently, and then people are eating healthier. One of the things that's interesting to note is the U.S. per person meat consumption is falling. In 2006, the average person consumed 222 pounds of meat. Combine that with what we're taking a look at for 2013, that's 204 pounds. So there's a clear drop-off, around 18 pounds a person per year, eating less meat. So obviously that requires less meat, which will, supply and demand factors pulling at it would have less slaughter as far as the cattle rate goes. So they would need less feed. So, that's one of the things that we see taking domestic feed demand lower. But then also I kind of want to focus on just this U.S. corn total domestic usage chart right here. If you take a look at the blue, which is the other feed, seed, and industrial again, you take a look at the life of this chart, which started in 1987. It's pretty much remained constant. There's not a whole lot of change there. You take a look at the orange, which is feed and residual. There's some fluctuation there, but it always seems to want to hover around that 5 billion bushel mark. We don't see that changing. We think feed and residual is going to hang around that 5 billion bushel mark, and we think that the other FSI, which is the feed, seed, and industrial, will remain the constant as well. So what does that leave? Well, that leaves ethanol. So if you take a look at this here, take a look at ethanol here, we've kind of been expanding here, kind of an expanding triangle. Ethanol, as soon as we introduced it, it's really helped the U.S. total domestic corn usage go higher and higher and higher. Well, as we discussed earlier, don't see much more expansion in the ethanol market. We see it flatlining at best and receding at worst. So we believe that this is probably going to peter off right here and potentially even go down just a little bit. Don't think that this is going to change a whole lot. So we see the feed and residual and other FSI staying the same while the ethanol declines. So we think we're kind of topped out on this U.S. corn domestic usage right now. Don't see a whole lot in there that's coming down the pipe that's going to change this. So with that said, let's get rid of these drawings here and move on to the next step here, which is production. So production, we're going to take a look at two different charts here as far as production goes. We're going to take a look at the U.S. corn production, and we're going to take a look at the world corn production. So let's go to the U.S. corn production here. And I want you to focus on the right side of the chart over here. And obviously, it's pretty easy to see why we had such the high prices that we did that we went over early in the continuous chart. We had sub-trend line yields for 4 years in a row. We haven't seen 5 years in a row since 1850, so chances are we're probably going to see above or at sub-trend line yields, not sub-trend line yields, but above or at trend line yields this year just based on history and what it's told us. And production should remain high unless we get a weather issue or some type of natural disaster. So it's very easy to see why we rallied like we did. Focus on the right side here, and boom, boom, boom. I mean, 3 very down years, especially in 2012. Let me get my drawing tool out here. Huge down year. It's easy to see why prices fell like they did this year. Much higher production. Record high U.S. corn production. So it doesn't take a genius to figure it out when you take a look at this chart. You could look at this and figure out what prices did the last 4 years just based on this chart. And let's take a look at the world production as well. And same thing. Look at 2012. It's no secret why we were trading almost up at 850 in 2012 and why we're at 427 right now. Down production year worldwide in 2012. Did a great job rebuilding stocks in 2013. Doesn't take a rocket scientist to figure that out. So I mean, take a look at it again here. U.S. production down, then really increased. World production down, then really increased. So one thing I also want to note here is we touched on, we don't see production going lower short of weather or natural disaster. Well, when we had that 2012 market rally, we had already had a few bad years in a row, a few drought years in a row that really had kind of supported prices, and that's what took us up to that near that 850 level. We've done a really good job rebuilding stocks, so we're not near as tight coming into this year as we were 2012. So even if we do get some sort of weather event, probably not going to see prices jump near as high as they were in 2012, as we're not nearly as tight as far as stocks go on that. So just something to keep in mind, even if we do get a real big weather rally, which could happen, probably not going to see those 2012 prices. So with that said, we covered the corn market here. Now we're going to jump over into the soybean market. So let's, just like we did with corn, we're going to give you an idea on what we're going to cover for soybeans here. We believe that the 2013 corn market and the 2014 soybean market are very similar. As we just noted, the 2013 corn market, they did a great job of rebuilding stocks. And therefore, the stocks to usage ratio is not nearly as tight. You don't want to say you can afford a drought year ever, but it's not going to hurt us nearly as bad as it did in 2012 for the corn market. So supplies were tight coming into 2013. They were really rebuilt this year. We think the same is going to happen this upcoming year for the 2014 soybean market. Ending stocks are very tight. We'll cover that here in a little bit. We believe that planted acres and production should fix those ending stock numbers moving into 2015 after this 2014 year is up. So we believe that the 2013 corn market and the 2014 soybean market are going to be very similar. We'll also go over China. We'll go over planted acres, and then we're going to go over stocks to usage. So let's take a look at where we've been in the bean chart. We don't have to go back to 2010 like we did in the corn market to find the last time we traded at current price levels. When I say current, obviously we're not at the bottom of this blue line here right now, but it wasn't too long ago that we were. So let's take a look at this here. Last time we were there was the first quarter of 2012. So what happened here? Obviously, we had a very big drought that year, sent prices higher, almost coming up to $18 here. Didn't quite hit 18, but it darn near got there on a continuous bean chart. So we got into 2013 here, and we did a decent job. We had a decent crop this year, 43 bushel per acre average, but it's still, there weren't enough acres planted and production wasn't high enough to really bring bean prices down conjoined with the corn market like it was. So the market's job this year is to entice people to plant beans, and we'll get into that here in a little bit when we get into plant acres, but we believe that is going to happen. So Don't have to go back near as far as where we were in corn, but we do have to go back to the first quarter of 2012. That is almost 2 years ago since we've been at current price levels. So with that said, we're going to take a look at China here. Those of you familiar with the bean market know that China plays a big role in it. So let's take a look at domestic usage for China. Obviously, taking a look at this, it's pretty clear that it remains strong. China's adding more and more protein to their diet versus U.S., where we seem to be taking some away. So their demand and domestic usage is going to continue to remain strong as their diet continues to change. So we believe that demand should help support old crop prices as supplies remain tight. Now, of course, we've got a record crop growing down in South America right now that will help ease these front month concerns as far as tightness. And once that South American crop comes in, it could pressure prices as they'll be competing with the U.S. for exports. I saw a figure today after today's export sales, which we had a lot to China. Export sales have remained very strong, that we're over 90% complete for what the USDA has us pegged at for this marketing year, and we've got 36 weeks to go. So we are real high up there as far as what they expect us to market. A lot of that's going to China, but there's a lot of concerns that China's going to cancel or roll over some of these cargoes that we've gone. But we're not going to talk about that too much in depth today. We're just going to take a look at their domestic usage right now, which, as you can see, remains strong. So with that said, let's take a look at China's imports. Very, very, very similar compared to what we just looked at over here on the domestic usage. So what does that tell us? They don't have the infrastructure over there to produce the soybeans they need that they consume domestically. So they rely on producers, a lot of the United States, to provide them with the soybeans that they need. I mean, you can just take a look at this chart here, and we're going to draw a line here. Let's draw just a clearly uptrending line. Boy, don't we wish our portfolios all looked like that. That'd be a happy day for all involved, right? But anyhow, let's take a look at this now. Let's take it over the domestic usage chart. Fits right over it. So it's no surprise there that China is having to use quite a bit of imports to meet their domestic usage, and the U.S. is providing a lot of that. Most of our use is really unchanged over the last decade. A lot of the usage here in the United States is going from exports, and it's going over to China. So we believe that they will continue to import beans at a strong pace, but we think they're probably going to stay at current levels. We think they might be a little topped out and a little top heavy as far as the imports go for China. So we don't see a whole lot changing as far as that goes for 2014. I believe it remained pretty constant to what we've seen here this past year. So really don't see a whole lot of a demand-induced rally in 2014 due to that. So it has been strong, and it will continue to be strong. We just don't believe it's going to change much from where we currently are. So with that said, let's get rid of our drawings on there. Now we're going to take a look at planted acres. So if you take a look at planted acres here, back in 2009, planted a record crop. Almost did it in 2010. 2011, planted a little less. 2012, prices were pretty good, and the market went back up to almost a record. And then, of course, in 2013, we weren't too far off a record as well. That's 2013. Right up here is where 2014 planted acres are estimated to come in. They're estimated to come in at 82 million acres for the 2014-15 crop year. So combine that with the fact that Argentina has around 50 million acres in the ground right now, and Brazil has around 71 million acres in the ground right now. It's over 200 million acres of beans for 2014-2015. We've also got the South American harvest ramping up. In January, parts of South America will start their harvest, and that could weigh a little bit on the U.S. exports, as we noted on the previous slides. But we've got that ramping up. So the world is about very close to having a glut of soybean supplies, assuming normal weather moving forward. So as we kind of went over with the corn market, as we said, the theme of this is the 2014 soybean market should be very much like the 2013 corn market. 2013, we planted a record amount of acres for corn. We're expected to do that for 2014 soybeans as prices demanded that for corn this past year. We're looking like they're going to demand it for soybeans this upcoming year. So with that said, we're going to take a look at the ending stocks to usage ratio. As you can see here, look at the right side of the chart. The orange line is ending stocks, and the blue line is the stocks to usage ratio. It's extremely tight, and it's going to remain tight until one of two things happen. Either export demand falls or we increase supplies. Well, as we went over, we believe that China imports will remain strong, and we believe that our exports throughout the world will remain strong. We don't believe that they're going to get much stronger over there, but we do believe that they remain strong. So we don't see export demand falling, but we do see supplies increasing. And if you paid attention on the last slide, you know why. Planted acres in America, planted acres in South America should do a great job of increasing supply. So just think about this for a second. If we put 82 million acres into the ground and we produce the same yield that we did this past year at 43 bushels per acre, production is going to jump 300 million bushels from last year based on that. And that put production at 3.5 billion bushels. So with that said, that would put ending stocks at around 450 million bushels. So just to graphically show you that, which you've got it here, that's this line right here. So that puts it around 15%, which is right around where the corn stocks to usage ratio currently is. Again, going back to our theme, we believe that the 2014 soybean market is going to be very much like the 2013 corn market. So if we do that, if we grow that, if we put 82 million acres into the ground like we're expected, exports remain constant like we think, we believe that we should do a great job rebuilding stocks, and that's why we believe that that we should do a good job, much like the 2013 corn year. So for those of you that aren't familiar with what the stocks to usage ratio means, that 5%, that means we've got 5% of our expected demand towards this next marketing year. So after we used everything for this past year on what we needed, we're expected to have 5% left over. So think of it as Thanksgiving leftovers. If you got some turkey left over and you've only got enough to make 5% of a sandwich, we're going to have to go out and get 95% more of a turkey to make that whole sandwich. That's kind of how it is with the stocks to usage ratio. So hopefully that makes sense to you. So with that said, mostly what we've gone over here has been somewhat bearish. Obviously, there's fundamentally not a whole lot out there to support these markets right now as far as price-wise moving forward. But as we all know, markets don't go straight down or straight up. So with that said, what could be bullish in the 2014 crop year? Well, of course, weather. And if you all remember, we had some planting issues here in the U.S. this past year. So let's see what it did for the corn market. We had multiple times in this blue box, that's from the end of April through June. As you can see, we had multiple weather-induced rallies there due to planting concerns. It was extremely wet here in the U.S. You saw pictures all over of tractors getting stuck, not able to plant, and it induced rallies on concerns that the crop was going to be pushed back and it was going to be pollinating later in the growing year. Therefore, more heat, August heat was going to affect that and come up with less of a crop. Same thing for soybeans. Soybeans had the same concern. And soybeans, didn't get into the ground until very late this year, and then we had a very dry August, and that caused much concern over the soybean price. So we got a nice rally. So it's just if you look back in April 2013 front month, we were down around $12. We shot all the way up to around 1330, 1340 levels. So that's what a planting delay can do, especially when prices are pretty vamped up like they are in soybeans. It doesn't take much to get a $1.30 rally. So planting delays are something that could really help support the market here. And then, of course, droughts. 2012, which is an extreme example. Let's take a look at the corn chart here. Obviously, as mentioned earlier, don't see prices getting up near the 850 level again if we experience a drought like we did in 2012, just because our ending stocks have been revamped so much this past year. But you can see what a drought year will do. It'll send prices higher. So if we get a drought year, we don't see it going 850, but we do believe that it will obviously support prices. And then, of course, same thing for soybeans over here. Almost got up to the $18 level in soybeans based on that 2012 drought. So weather always is the wild card every year. If we had normal weather, whatever that means nowadays, every year, obviously different supply and demand factors would weigh out based on price and how much we would plant, but we don't. There's going to be some weather hiccups every year. Nothing ever goes perfect as planned, whether it's here in the U.S. or whether it's down in South America. So there will be some weather opportunities for you to trade on throughout the year or market. There's always some great opportunities that weather presents to book some more crop. So with that said, let's go over our summary here. Just kind of give you an idea on what we went over, and we'll give you our price outlooks in this as well. So corn supplies have been replenished. We did a great job replenishing supplies in the 2013 growing year. We believe that the ethanol mandate will be lowered and that export competition will remain constant. Our export dominance is lost, and we run into the blend wall as far as ethanol production goes. Production's up. Great job in 2013 replenishing ending stocks. Ending stocks are now over 15% and not near as tight. So therefore, as noted, even if we do have a drought year like we did in 2012, don't see prices getting up to those levels. So assuming normal weather, again, whatever that means, we believe that the 2014 harvest price outlook should be around $3.15. And that, normal weather, obviously being no extreme heat, rain when needed. So we believe that the 2014 harvest price outlook for corn is $3.50. So let's jump into soybeans here. China demand remains strong. We went over that earlier. It's strong. We expect it to remain constant moving forward, but it does remain strong. As we noted, their imports is curved up exactly like their domestic usage. They're going to need to continue importing soybeans as their diets change. We're just going to have a little more competition from South America and other countries than we used to. U.S. usage isn't really changing. As we went over that earlier, briefly touched on, our usage isn't changing much as the diets change here in the United States, and it is overseas, but it's not changing much, so our usage should remain constant. So don't see any increased demand out of there. And we believe that 2014 should replenish supplies much like the 2013 corn market. I believe I've harped on that enough. I don't think I need to explain that much more to you. So with that said, our 2014 harvest price outlook, the normal weather year, we see going for $9.50. So with that said, how do you take advantage of this, whether it be marketing, whether it be trading, whether it be hedging? Well, the NFA has some very strict requirements for us as we're a registered brokerage. So I got to read you this disclosure here, and it's because we are registered, and this is a webinar, the NFA has regulations discouraging us from sharing specific trade recommendations with you during this event. However, we do have very specific strategies for both hedgers and speculators based on what we have discussed today. We encourage you to contact us to learn the exact strategies we'd employ based on your circumstances as a trader or producer. And once again, before you enter any trade, you should know and understand the risks of trading futures, options, and spreads. So with that said, what are we looking at? We're looking at shorting December 14 corn. We've got very specific levels that we're looking for it to hit before we get short or before we add to the short positions that we've already got on, but we're definitely looking at shorting December 14 corn. Should come as no surprise as we gave you the harvest outlook earlier. We're also looking to sell rallies in the November 14 soybean market. The soybean market is much tighter right now than the corn market is, so there's obviously going to be rallies as we continue to get information on increased demand out of China. It's expected to remain constant this year, but they've been very good buyers this year. As noted, they could cancel out on some of the cargoes that they've been shipping later or cancel them over. But we believe that that's enough to cause some rallies in there, is whether weather, demand rallies, anything like that. We believe that selling November 14 soybean rallies is a good idea. Again, should come as no surprise to you due to the fact that we went over our harvest price outlook earlier. We also have very specific option strategies. Can't get into the nitty-gritty on those as noted due to being registered and this being a webinar. call us. More than happy to go over them for you. We got specific ones based on whether you like margin or whether you don't like margin. We've got an option strategy for you, and can let you know how we're doing it for people in your neck of the woods. So that's kind of our trade and hedge ideas. And one thing I want to go over here real quick is take a look at this picture here. And as you see, the rear view mirror, it's very clear. Yet when you look outside of it and see the road ahead, it's very blurry. A lot of the things we went over in those continuous corn charts was the past. Very clear to see what price action was in the past, and very clear to see what caused it to do what it did in the past. The road ahead's not so clear. Once things are known, it goes in the rear view mirror there and is already priced into the market. So it's our job to try and stay ahead of that and make the road ahead a little less blurry for you by coming out and letting you know our opinion on the market, where we think things are headed. We gave you some of our ideas on what we think is going to affect the market in this presentation today, and how our ending price should be moving forward. We've got some very specific tools here that I'm going to show you here in a sec that can try to help keep you ahead of the market and make this road a little less blurry for you, because as we know, if we know it, it's priced in, you're too late. If you're reading it in the Wall Street Journal, probably not the best idea to call up and try and get going with whatever recommendation or idea they've got there. It's already taken place in the market and already been priced in. So with that said, kind of what we just went over there, we want you to have fun in these markets. These are fun markets. They present opportunity, whether you're a producer or a hedger or an elevator, or you're just trying to assume risk and trade. These are very fun markets, but we want you to stay safe. And how do we do that? Well, we've got a couple of very specific things that we believe that can keep you informed on the market and help you hopefully make the best informed decisions possible. I'm going to go over that right now. The first one is grain analyst. So Andy Daniels is the grain analyst. This is published by Andy Daniels. I actually do if you remember from when we went over my bio earlier, I do the daily report over at Grain Analyst. So I'm one of the editors over there. So, but most of it's published by Andy Daniels. That insider perspective comes straight from Andy's keyboard, gives you his thoughts on the markets. It's something he used to just do for his clients. Wanted to get it out to a broader reach as so many people demanded it. So that's what we've done here with Grain Analyst. And it also gives you an insight at the trades he's looking at. So you get access to insider perspective, Andy's trades. We've also got an awesome real-time USDA update page over there. You can get a free trial for 30 days, and that's going to go out in the follow-up email to this webinar. So I think you'll really like that. If nothing else, the free trial or the USDA real-time update page is great. Once the reports are released at 11, just click refresh, and you got everything there. And right now it's only U.S. data, but we're working on getting the world data in there as well. So that's something that we've gotten some really good feedback on. And then you got the Wilkins Ag Wire, which is published by yours truly. It's a daily video I put out. And sometimes some occasional extras if something's going out in the market, or if we've got a USDA report that day, I'll follow up with an afternoon video. So that's free of charge, and you can just sign up for that. Again, there will be a link in the follow-up email to this. So with that said, we're going to jump into some questions here. Let's see what we've got as far as questions go. I'm going to take a look at those. I'm going to run through these risk disclosures here real quick. If you've got any questions, pop them in here, and we'll get going here. So let me review these questions, and we'll be right back. All right, so I got my contact information back up there, so if you want to write any of that down, now's the time. So we've got a question here about DDGs and their effect on ethanol. So it's basically the question is, what about DDGs? You hear all this food for fuel. Well, the corn is still produced as food due to the fact that it comes out with DDGs, which for those of you who don't know, it's dried distilled grains, and ethanol process, what they do is it's basically just cracked corn, and they really rinse the sugars off of it and produce alcohol. Those of you that maybe have ever made your own beer before, home brewing is blowing up here in the States, will know a little bit about that. But the leftover spent grains are known as dry distiller grains, and those are sent over and used as feed as well as exports as well. It's interesting. China is actually said to start testing cargoes for DDGs, and if you've been following them on their corn imports lately, they have been finding this unapproved GMO strain, I believe it's from Syngenta, that they're rejecting some corn cargoes based on that, and these DDG containers going over there are expected to contain that. So that'll be interesting moving forward. But yeah, you're right. Ethanol, it's not just food for fuel. It does go back into the food cycle as well. So it'll be interesting to see what kind of take that has as well. So we've got another question here. It's do you believe that the corn market will make the new low till the end of the year? That's from Igor. Yes, Igor, as noted, the harvest price is what we expect to come in at 350. Obviously, there will be some gyrations throughout the year as we went over. No year is a perfect weather year. There will be some spikes, but yeah, our harvest outlook is the $3.50. All right, so that's just had a couple questions. Let's see if anything else rolls in here in the next minute or so. Otherwise, we will wrap this up. Sounds good. Thanks a lot. You got another question here. Is it as far as the harvest price? Are you talking cash or futures? Futures. So that's not including basis, just futures. Good question. Okay, got another one here if we have an oats outlook. That's not a market I follow extremely closely, Darren, unfortunately, so I do not have an outlook on the oat market. All right, looks like that might be the end of the questions rolling in. I'd like to thank you for taking the time out of your day to listen to what I've got to say. I appreciate it. Always enjoy presenting these things, letting people know our outlook on the market, and then also really helping folks take advantage of that. That's one of the things that obviously we can't give specific recommendations here based on the fact that we are registered and we're a brokerage firm, but give us a call, and that barrier is broken. We're more than happy to go. We got very specific recommendations, something we love talking about. We live and breathe these markets every day, just like I'm sure a lot of you do here, whether you're producing, whether you're an elevator, whether you're someone like myself who's a broker that's attending in on this webinar, or a consultant. We live and breathe these markets every day, so they're our livelihood just like they are yours as well, and really enjoy talking about them, and like to thank you for taking the time out of your day to listen to what we've got to say, like presenting it to you all. So much appreciate that. One more thing coming here from Terry. Basis at Harvest 14 could be very wide. You're exactly right, Terry. So I think we've got more grain bins going up than we ever had, and I imagine that will continue. You can't deliver it all at harvest, but as we can increase having these record crops, if that continues, storage is going to be at a premium. You're going to see a lot of those grain bins popping up all throughout the United States as harvest prices could be pretty depressed here, and bases are pretty wide depending on the area that you're in and the availability of grain at the elevator. So you're exactly right there, Terry. That's a good point. So with that said, we're going to wrap this up. Thanks again for attending, taking the time out of your day to hear what I've got to say. I appreciate your confidence in coming in and joining the webinar. If you have any questions, my contact info is over here on the screen. Email, contact me on Twitter. Can't get into specific recommendations on Twitter exactly like I can here on the webinar, but email, phone, just give me a holler. More than happy to talk to you about it. So thanks again. Have a great day.